Hello, good morning and afternoon to everyone who's joined us again for one of our virtual Captive Reviews virtual series. We are really pleased today that we're going to welcome a new sponsor of ours, RiverStone, for the virtual series. So it's great to have them on board, and a big thank you to RiverStone for their support. And we'll be seeing a bit more of them later in the year with some of the other projects we have underway as well. The hard market has had many discussions about the increase in number of inquiries we've had about captives, both from firms who have yet to have a captive, but also from firms who are going to have a captive for the first time. But those who have a captive already, what we're going to also talk about now this afternoon is take you on a road trip. We're going to talk through migrating through the cruise control of what a captive has been designed to do, and it does well. But then we'll look through the diversions, the wrong turns, and ending up with the exit of that. And keeping us along with that analogy, I will introduce the speakers shortly to you. But just before I do that, we love to make this as interactive as we possibly can. So any questions that you may have, you can pose them to our panel. We use a separate web tab called slido.com. That's slido.com, and you just need to enter the hashtag captive review. There will be a couple of poll questions in the session as well. And again, we ask you to visit that website, click on the poll tab, and then you can answer your questions there. So I'd now like to just introduce to you our moderator for today, which is going to be Matt Kunish. Afternoon, Matt.
Hey, Nick, how are you?
I'm very good, thank you. Matt, you are the Chief Business Development Officer at RiverStone, and you're going to be walking us through this. That's right?
Yep, absolutely.
We've got a lot to get through then, so I will hand over to you to introduce your panel and get the afternoon started, or morning.
Yeah, no, great. Thank you, Nick, and echoing the good morning, good afternoon, wherever you are in the world today. Obviously, as an English football soccer fan, today is a big day in the history of English football, so I'm going to be looking forward to watching that game this afternoon. But for now, we're on the captive road trip, as Nick said, and he mentioned, I'm the Chief Business Development Officer at RiverStone. RiverStone is part of Fairfax Financial, and we specialize in runoff or exit solutions for captives and other risk-bearing entities where those entities are no longer needed for their owners. So I'm going to start now just introducing the panelists one by one. So Marcy Van Stee is a colleague at RiverStone. She leads the US acquisition team for RiverStone, handling sort of the client contact as well as the due diligence process. Prior to joining RiverStone, Marcy had a long career in the insurance industry as a claims adjuster, so she brings those expertise to the table as well as her acquisition responsibilities. We're also joined today by Seamus Tivnan. Seamus is a managing director of SRS in the Cayman Islands. He's responsible for the management and supervision of client accounts, financial regulatory reporting, and he's also the co-head of the firm's healthcare practice. So welcome, Seamus. Greg Nowakowski is a partner at Honigman. Greg assists clients on all things related to captives, whether it's the formation, the feasibility studies, the domiciles, various structures that are available to owners, and insurance policy provisions, as well as representing the captives once they're set up in their ongoing business. So welcome, Greg. And then finally, we have Damien Pentney, who is a partner at PwC in the Cayman Islands, and Damon has leading that practice responsibility for audit, advisory, and regulatory consulting. So welcome, panel. today. As Nick mentioned, we're going to go through the journey of a captive from the startup, things you need to be aware of when you're setting up the captive, moving on to once the captive's up and running, any issues that may happen to the captive during its life, and then some sort of war stories from us as experiences of how problems were solved or issues were resolved. And then finally, just alerting people to the fact that, often there comes a point where the captive no longer makes sense for various reasons, and there are opportunities to sell the captive or transfer the liability. So we're covering the whole life cycle of the captive today. We're going to start off with a poll question. So Shannon, if you can put that up while I ask Seamus the first question, which is, what are the key things and best practices captive owners should be doing when they set up a captive? What works and what doesn't work? Seamus.
Thanks, Matt. Thanks for the introduction, and good morning, good afternoon, good day, everyone. So firstly, I think the feasibility study, it may be seen as an unnecessary spend of $20 or $25 or even more $1,000. But in the grand scheme of things, it's highly worthwhile, and to me, it's an investment. I'd say, I don't want to give away how many years I've been in the business, but maybe 20 years ago, 10% lesser captives did this. Now I'm hoping 50 or 75% do it. It's a roadmap for license application, and you can use information from the feasibility study in that license application, but also in 5, 10, or 15 years' time for the people that form the captive. It's a document that gives people who are left behind the rationale behind why that captive was formed. It was good risk management decisions at the time, and it also documents what jurisdiction they decided to go to. Now, it may sound self-serving because as a consultant, we get fees for doing feasibility studies. In the grand scheme of things, it's a small amount of money, and it really is, it's a great document to have in that bottom drawer in 10 or 20 years' time. Then I think whoever's setting up the captive, you've got to ask the question, does the company or the family, the entrepreneurial ownership family, have the stability or the stomach or desire this to be a long-term project and have the capital to start it and sustain it? It shouldn't be a knee-jerk reaction to a hardening market condition. It's not a well-thought-out risk management plan. And then which jurisdiction makes sense? It's obvious to me it's the one that's 482 miles south of Miami, but before you read the maps, you should consider the operational standpoint of the captive, where it's doing business, its tax consequences, and what jurisdiction you pick. It should be an easy one to get to, because the owners and management of the captive need to meet with the service providers, and most importantly, the regulator. You have to keep a good communication channel open with that regulator. And then in these days of, I'm not going to say over-regulation, but of consistent good regulation, things change. And so we got the economic substance law for those in offshore jurisdictions. So it's got to be a jurisdiction that everyone can get to. Corporate governance, especially if it's a corporation, you need to have the input from the, I'm going to call it the C-suite. People that run the company, they need to be willing to give their time up to spend time with the captive to make sure it works well. And if it's a family-owned captive, the owners, the family office, the trustees, they need to be involved. And then it comes down to, once you've decided the captive's ready to go, you need your advisors. Now, you have the best on the phone with you today, Matt, and thank you for that. But there are lots of others out there. You need an actuary in most jurisdictions. You need an auditor in most jurisdictions. You need a banker. You obviously need a captive insurance manager, your investment team. You'll need a legal team, both for the jurisdiction that you're operating in, but also in your home territory, to let you know the laws about where you're writing policies. And then you'll need the insurance consulting team. And not every insurance captive owner has a broker, but most do. But you'll need the broker, the insurance consultant on the line. Not all of these are in every captive. Some captives operate for a low cost, but the best run captives are the ones that have these involved. And I think what works is an engaged client that's not looking at saving dollars on expenses, but looking at investing in good service providers to make sure the captive is successful. Because all the consultants, they cost money, and but the successful captives can look back in whether it's in 7 or 10 years time and say, this investment of time and money that we weren't spending before the captive has really paid dividends. That's my quick top and worth on that.
Great, thank you, Seamus. Greg, any thoughts on that?
Yeah, thanks, Matt and Seamus. Great points. From a legal perspective, what we tend to think of at a high level in sort of one sentence or maybe even less than one sentence at captive formation when a client comes and says we want to do this is make sure that you go into that with your eyes wide open. What does that mean? Let's sort of break it down a little bit. So ensuring that you know what the insurance risks are, what the financial risks might be. Seamus mentioned this as well, the time and attention that a lot of this requires. And for many of our clients, they come to us, they're not insurance folks to begin with. They're the business that they run, that they want to insure, that they've been buying commercial coverage from, that they either no longer want, can, or can afford, and they want to create a captive to fund some of that risk. And so, there's a steep learning curve. It takes a number of years to really understand what's going on, but knowing what as much as you can at the beginning, and this sort of harkens back to Seamus's comment about the importance of a feasibility study, sort of outlining each of those areas and educating the clients or the potential captive owners and insureds what it really means to have a captive, so that down the road, when there needs to be a course correction, that course correction doesn't result in the cratering of a captive. And then, and the final kind of general comment here that I'd like to make is, and I know there's a question on this later in the seminar, but considering how things work in unwinding, whether it's withdrawal or exit, is really important to understand and address upfront, so that the legal documentation, from my perspective, can protect the interests of the client in setting it up. So, clients come to us, for example, on the insurance risk piece of this. A client will come and say, we want to create a captive, and as part of that, we want to insure a joint venture. It's 51-49 or whatever the ownership is, and they've failed to consider what the insurance risks associated with insuring that joint venture. Are they exposing the captive that they own to the 49% owner? And they're not thinking through all the issues that are important to us. Another one, in a group captive setting, 5 physician practices got together with an eye towards creating a captive, and they wanted to think about expansion to other groups. All well and good, set the captive up from a legal documentation perspective as a cell captive to provide them opportunities to either create a separate cell, issue different classes of stock, all these wonderful flexible things. But what the groups failed to consider was, who are the new participants up front, so that when the opportunity arose, many of these issues were already nailed down to the best extent they could. Would a new participant have a board seat? Would they share in the profits and losses of the company? Would they just be a participant, or would they be a participant and an owner? A number of different questions that are potentially could be addressed in a feasibility study, or just generally documented in some sort of fashion, so that there would be a meeting of the minds. And with that particular group, they're kind of at a standstill, and so can lead decisions in the beginning, if you don't go into this process with your eyes wide open, can lead to course corrections, and God forbid, in some instances, non-voluntary exits. I'll put it. So I'm going to stop there, and unless there are any questions at this point, Matt.
Great, thanks, Greg. Damien, your thoughts from the audit side?
Thanks, Matt, and good morning, everybody. Yeah, I think Seamus outlined very, very well all of the key points there, and I agree with Greg's comments too. As both Seamus and Greg started with, when I think of formation, I think of understanding what the purpose is behind the captive. Being clear on what is the strategy or objective, and as Seamus said, make sure, I think in his words, it's not a knee-jerk reaction to something. Make sure it's a well thought out, well-rounded consideration almost like a balanced scorecard of what are the various components of this, and not just what are the key drivers, but also what are the ancillary benefits that we're going to get from this captive, so we can articulate those in our business plan. I love Seamus's comment on the benefit and value behind the feasibility study. I fully support that. And I also like the idea of understanding where are the sensitivities in that. You know, what happens if investment yields drop below what's projected? What happens if there's a tax rate change? You know, understanding those things at formation can help a captive position itself, or the governance team position itself, so that when those changes happen, they're not making knee-jerk reactions to those events, but they've thought them through. They understand, the members understand, all of the stakeholders understand what capital cash flows there might need to be in certain circumstances, and have bought into that. I think getting stakeholder buy-in, especially at the the governance level, is critical, so that they understand what happens when those circumstances unfold. I also like the idea of involving the governance team, the board, the C-suite, whoever's charged with governance for the captive, in that feasibility study, and in the objective and the purpose design behind the strategy, to make sure they understand and know what it is. I always makes me smile, you know, the times that a board member asks me to have a one-on-one discussion around what the purpose of their captive is, and this is someone that's been, you know, on the board of their captive for many years, and there's always good reasons. It's just often the C-suite forget or don't revisit or remind themselves of what those great objectives are when they established their captive, and whether they're still being achieved, whether it's still meeting their needs. My last comment, I was going to touch on selecting vendors. I think Seamus covered it very well. I like to think that the best and most valuable relationships start with a meaningful discussion. Not just an RFP, not just a piece of paper, an actual meaningful discussion where the drivers behind the management behind the captive understand what they want from a service provider, have given some thought to what's meaningful to them, and start with a good conversation. And if they're going to go get references, you know, pick up the phone and have a conversation with the references, rather than just asking for something in writing. You get much more meaningful conversations and value out of a discussion than you would do out of just a proposal on paper. And I'll pause there, Matt.
Yeah, no, thank you. And I think, you know, certainly from my perspective, having been sort of in the insurance industry for, you know, too long at this point, I think, but the thing I've been surprised at, or has been interesting to me with the captive space, is that you've typically got relatively smart people who don't have insurance experience. So when they're asking questions, you get sort of different questions than you're used to, and they're very fundamental questions. And I think, as you know, advisors, it is important to realize that we're not necessarily talking to you know, insurance professionals. These are you know, may well be business owners, very successful people, but just don't have the expertise in the insurance space. So it is important to sort of pitch those conversations at the right level, and make sure you know who your audience is. So let's just have a quick look at the poll before we move on. Obviously, these are loaded questions, but based on the responses, I think managing the financial volatility of the captive comes out the clear winner. For people who've just joined, the polls are at slido.com, and you just enter in captive review in the hashtag when you get to the website. And that's also the place we're going to be using for any questions that you may have. So please take a moment to go to slido.com and get logged in with captive review. So we're going to move on now to, you know, we've got the captive set up. We want to talk about some of the themes you've seen, our war stories of where captives maybe have had issues. Doesn't necessarily mean life-threatening issues, but just things that have happened, 2, 3, 4 years into the captive. So I'll start with you, Damien, on some of the things you've seen that maybe weren't expected at the start.
Thanks, Matt. And I'm actually really interested to see that the last poll had market volatility as the one of the key messages. Because as I thought about this talking point, I sort of bucketed my themes into 2 layers. One was that category that happens fast, things that cause a rapid change or a rapid impact on a captive, and then things that cause more of a slow bleed. So, and as I think of those things that happen rapidly, it's things like, think back to 2008, 2009, when the fixed income markets experienced extreme volatility. That impacted not just captives, but the businesses behind captives who maybe needed cash flows and caused them to rapidly reevaluate their strategy at that point in time. Another one that caused rapid change, 2020, the market volatility in general. I mean, it was, the swings were volatile, and for a lot of captives, that caused them regulatory capital pressure when they were, the unrealized gains and losses, unrealized losses had mounted and was maybe causing them just capital pressure. You've also got sort of catastrophic events, so not just in the capital markets, but in the insurance markets. Depending on your lines of coverage, you could have a catastrophic event in the situation of a something like a flood or a wind-related event, or you could have an individually significant claim that causes a real systemic problem for an organization. And so those sort of groups of events happen really quickly and can cause a captive to have to evaluate that impacts and make some quick changes. And then you've got the other categorization I said of sort of the slow bleed, and that's things like general reserve deterioration. It can be caused by many things. Insurance by definition has volatility associated with the exposures covered. And so general reserve deterioration typically can happen a little slower, absent of individually significant events. It typically can happen quite slower over a prolonged period of time. And often I've seen boards look at it and think it's just a blip. That 1 year, that was just a blip. We'll get back on track next year. But they haven't actually got to the root cause. They actually haven't peeled the onion back to understand what is underlying that and what has been driving that to actually address the root cause. And then you can get this slow impact of slowly chipping away at the capital of a business that can create challenges. Greg touched on screening members, looking at members you're admitting to a captive, what their objectives are, what their understanding of the program is, their commitment behind any capital cash flows that may be needed, and understanding of those cash flows. And so changes in membership groups can also cause challenges, especially where they don't have a full understanding of what they're subscribing to when they join a captive. And then last of all, investment decisions was a thought I had. Absent of the sort of the highly volatile things that I spoke of, actually not investing, so just holding cash and not having any income yielding assets is just going to erode capital over time. And likewise, making the wrong risk profile decision on profiling your investments that doesn't align with an organization's risk tolerance is another area where I've seen common problems arise.
Great. How quickly, Damien, just following up on that, whose responsibility is it to really put their hand up and say you've got a problem? Are the owners looking towards the advisors? Are the advisors waiting for the owners to? How does that interaction work when you start seeing issues?
I mean, ultimately the responsibility sits with the board of directors, but the reality is, in practical terms, they're looking to a combination of advisors, particularly their insurance manager, to help them monitor some of the data and start dialogue around, here's what we're seeing, what is it we need to monitor. I mean, ultimately it does sit with management, but I think it's a joint effort. When COVID happened back in March of last year, my team embarked on a set of conversations with our boards of directors to understand what was happening in their businesses. I'm not necessarily going to drive a change for them, but just making sure that they're engaged and understanding and thinking about it, and to see if there's any assistance we can provide. I mean, Seamus, I don't know whether you had any thoughts around that. Obviously, I'm offering comments on behalf of an insurance manager here.
But thank you, Damien. No, I'd agree. You hit it on the head with it. It is the board's responsibility, but obviously the board appoints different service providers and they rely on them. The actuary and the auditor really look at things in a rear view mirror. You can't point at them, but when there's a big lawsuit, God bless Damien and his profession, because they're the ones that get sued. But most boards will have an investment consultant management team, and they're looking after the investment portfolio as best they can in a market that's changing. They can't move the market, and they expect that most boards know what's going on. And then the insurance manager, he or she, records activity usually 3 months in arrears. But the insurance manager is a daily obligation to report to that company. The insurance manager really is the one that is the most has the most obligation to tell the board what's going on. And if he or she fails, they are at risk. But again, they get the information at least 30 days late. To be honest, most boards and most owners know what's happening in the markets. They know what's happening with their loss reserves before it ever gets to the insurance manager. But at the end of the day, everyone will look to the insurance manager for not sticking their hand up. But thankfully, as Damien rightly pointed out, it is ultimately the board's responsibility.
Right. Thanks, Seamus.
From a legal standpoint, Greg.
Before I just go to Greg, Shannon, if we can just put up the second poll around this, so you've heard a little bit of the conversation. So, Greg, while people are doing the poll, thoughts from you of what you've seen?
From my perspective, I like the dichotomy that Damien set forth, and we kind of break it into two buckets. One's a self-fulfilling prophecy, being a U.S. licensed lawyer, and that is, we see a lot of changes driven by U.S. legal changes, or at least legal changes that occur in the insured owner's domicile. For example, 2017 tax reform caused a few of our clients to be classified as a passive foreign investment company and incur additional costs associated with that structure if they kept it. So we engaged in the long process of exploring all kinds of different options, all the way from shutting down to restructuring to classify the company in a different way for U.S. federal tax purposes. So that was a pretty drastic, for that group, a very drastic course change. Not life-threatening, as Matt had mentioned, that not all of them are, but nonetheless caused a lot of education, governance changes, restructuring of boards, a number of different issues associated with that we're really still struggling through. And then the second, what that we often see is it's not about the money, it's about how much. And what's interesting with this one, and there's another client example, is that it's not always the lack of money, although it can be, and sometimes that can cause capital calls and problems from that perspective. But sometimes issues arise when there is too much money in the captive in terms of surplus. And if those issues aren't anticipated in advance, it can cause pressure on larger entrants, larger participants who might have the legal right to those funds, to want to leave and get that distribution, therefore causing the captive to crater. And that occurs from time to time, and it's not always anticipated. So having documentation about how much minimum funds you would want in the captive, how dividends are issued, and policies and procedures around those kinds of things can be important from time to time. And then I see on the screen, it looks like change in business priorities. is pretty well leading the charge, and that makes sense. We see sometimes course changes even if a private company goes public, and how those interests are addressed differently in those instances. Matt, I'll pause there.
Great, no, thank you. Marcy, thoughts from you on this?
Well, there's a couple of things you can do to try to get your captive back on track if you're starting to see some of the issues that were raised earlier. Somebody already mentioned the investment policy, so we need to make sure that liquidity is addressed, diversification, and I think a lot of it comes back to sticking to your initial strategic plan. So are you staying on track in that regard? There were some conversations about reserve adequacy, and I think Damon said that sometimes they see a blip and they just look at it as a blip, but it's important to dig in as soon as there's some irregularity and make sure that you understand the root cause so that a little problem does not turn into a big problem. I think also having the right service providers is very important. If you start to have issues with your TPA, for example, don't let it go on. It's something to address early to try to right your captive. The last thought I have about that is really communicating with your regulator. And what folks need to realize is your regulator is an expert and they can discuss options with you. So if you keep the conversation going early with your regulator, you let them know what's going on, they can help identify any issues. And I would say you can rebound from short-term setbacks. So the sooner you identify any issues, the easier it will be to recover.
Great, thank you, Marcy. And then, yeah, just picking up on the poll, change of priorities is the number one. Commercial market changes, I guess a few people thought that was an issue. I think it's interesting as you see the changes where obviously, as was mentioned by Nick at the start, seeing a lot of new captives form because of various pressures in the commercial space. I just wonder how often we see captives dipping in and out of the commercial space once they've, maybe Seamus, you can comment on, once the captive's set up, for, whatever the market environment is, how often do you see the captive looking at, the fact that it's a soft commercial market, so let's pause the captive, dive back into the commercial market for a few years, and then, riding out that traditional insurance cycle, maybe?
Thanks, Matt. So generally what we see there is taking advantage of when the market gets soft, maybe trying to get the limits lower, or trying to buy up more excess coverage above your what I always call the direct or primary layers, and trying to keep them for as long as you can. Because when the market gets hard, they're going to disappear, but you can hold on to them for a year or two by negotiating, or you put a consultant negotiating to try and keep them for a bit longer. That's generally what we see. It's rare. All right, actually, I've never seen, let's say, a captive that's been around for 5 or 6 years decide to not write the business in year 7 because we can buy it cheaper in the commercial, because then you lose your relationships. And those people that were your partners when you had a captive, they may not be your partners when you need them again in year 9 or 10. It's a long-term objective. It's a long-term goal. You need to keep your partners around. I mean, in the healthcare space in the last few years, we've seen, Zurich, CNA, QBE, probably a few others pull out the market, others reducing the limits. But to the people that were their friends and partners for 5, 10, or 15 years, they hung around an extra 12 months, or they're giving them more limits than what they'd give newer players. So it really is, it's still that relationship industry where, a bit like what Damien said earlier, pick up the phone and talk to people. Everyone's so keen to do all business by email these days. A phone call is worth 200 emails.
Greg and Damien chime in. Any concerns just on the back of what Seamus says that makes absolute sense with, COVID and the combination of COVID and the hard market, sort of record numbers of new captives being formed, that are these here to stay, these large numbers of new captives? Is this really sort of a step leap in the number of captives, or is this, in a couple of years' time, people are going to be looking at it going, why did I do that again? And I think it comes back to some of what you talked about, Damien, earlier.
Yeah, and I think look, there's always going to be a small proportion of new captives that aren't necessarily successful in their objectives. But as long as they genuinely went into this with a long-term view, then I don't see this as a blip. Absent of existential changes such as legislation like Greg mentioned, or tax rules, I don't see this as being a temporary step up in the level of business being written through captives. The key is having a long-term view. Does COVID change things? Not really, I don't think. I think we've all realised we're doing this remote now, but I think we've all realised that COVID hasn't really changed very much at all. It may have changed some of the risk profiles of the underlying businesses. They may have had to adapt. But I think the one thing we've learned over the last year is that adaptations happen swiftly, and hasn't really changed the core underlying purpose behind businesses, whether that be an operating business in the US or a captive insurance company.
Great. Greg, anything on that?
I agree. I think it's interesting. That question is, how do you measure that in the future? I mean, you look at healthcare reform and mergers at parent levels, and 1 + 1 = 1 captive, because the captives are merged. So it'll be interesting to see in the future or maybe impossible to determine whether we're right or not. But it seems like captives are continuing to grow, at least in ultimate popularity, and to fund risks at varying levels, and to use as a good vehicle to create those partnerships that Seamus was talking about. So I don't, I guess time will tell whether we're right or not, but I don't see it as declining anytime soon, other than with the mergers. There of course there's always going to be captives that don't meet the needs, and you have a feasibility study to always kind of look back to, hopefully say, okay, what was the purpose, and are we still achieving things, and yes, no, or was there a business course change that caused us to do something a little bit differently? But I think it's here to stay.
Great. So just a quick reminder again, going to questions and answers will be coming up in a few minutes. So please submit those in Slido. So now sort of the captive has been set up for a purpose. It's fulfilled that purpose. And I think Damien and Greg alluded to that there's times when not even the captive doesn't need to get into distress, but for other reasons, whether it's a merger, we've seen a lot of that in the healthcare space over the last few years. The captive all of a sudden doesn't have a home, or is no longer needed. So Marty, what are some of the options and the rationale around a captive that is no longer needed?
So the good news is that there are options, and they're probably not as expensive as folks think. So just as an example, worldwide, about 4% of the captives are dormant, and in the US, about 6% of them are dormant. So there's a lot of captives out there that aren't being used and might need some suggestions on what to do with those captives. So there are a couple of options. One, you can sell the captive outright. Two, one could sell the liabilities in the captive. Both of those provide some finality, and it would either reduce or eliminate the expenses altogether. And then the third thing that can be done is running off the liabilities on your own and stop writing premium altogether. The issue with that is it can be quite costly. So in the long term, if you're running off the liabilities, there's going to be ongoing annual expenses. And over time, 5 years maybe or longer, depending on how long it takes you to run off those liabilities, it could be in the millions of dollars just to keep that captive alive when you really are just trying to run it off, and you'd like some finality there. So some factors to consider. Obviously, we've talked about this a little bit earlier, but reserve adequacy is a huge issue when you're considering what to do with your captive if you'd like to extinguish it. You don't have any premium coming in, the claim volume shrinks, and at that point, maybe 1 or 2 claims could have a big impact on the financial standing of the captive. And as I mentioned earlier, the ongoing expenses can be into the millions of dollars. I mean, operating a captive is not cheap, as most people know. So that is something to consider when you're deciding, okay, do we run this off on our own? You still have to think about the cost down the road of hanging on to that captive. Another consideration is ongoing use for that capital that's trapped inside of the captive. So could that captive be better deployed elsewhere? Those are the considerations that one needs to think about when deciding exactly how to exit their captive, or should they.
Great, thank you, Marty. Greg, you've been involved in sort of certainly in the healthcare space, but as the captive owner is coming to you as an advisor, what are you sort of highlighting for them, in terms of options and things they should be considering?
Kind of think of it as two-step process, and the first step is really to challenge the assumption in the question. When the client comes to us and says we want to exit, whatever that may mean, whether it's any of the options Marcy had mentioned earlier, says, well, wait a minute, let's stop for a minute, pause, let's think about what the captive's purpose was or is, and is the captive still meeting that, yes or no? And often, sometimes at least, what happens is you dig a little bit and you find what the real driving interest is behind the exit request. And sometimes that has nothing to do with exit. Other times it has everything to do with exit. One case that comes to mind is a client, private equity firm, purchased the parent and said, well, wait a minute, what's this $40 million asset sitting offshore somewhere? Can't we get at it? We want the funds, so let's exit. Well, hold on a second. The captive isn't, it's one of those other reasons that Matt had mentioned. It's not that the captive isn't funding your risk appropriately, it's that the owners want the money back. Unfortunately, in that case, it was a workers' comp program, fronted. Most of that 40 million was tied up as collateral, so there was some education about how much can you really give back, and ultimately not a whole lot in that instance. Eventually, they wound up selling the ownership of the company, sort of in a stock sale, if you think of it that way, versus an asset deal, I believe, and they got exited in that fashion. So that's sort of the first step in any process in my mind. And then the next step is really working and knowing the folks and knowing the options, by which I mean you need to know the folks, for example, at RiverStone, who do this on a daily basis and can present the wide range of options and lead you through all the different players who may be willing to purchase. Who do you call? I mean, it's the folks that own captives often, as we mentioned multiple times, aren't in this business, so they need help getting the connections for who you may be able to sell the company or assets to. Without that, you're kind of forced to run off and spend the extra $1 million in fees. So we can recognize significant savings in that regard. So knowing the right players and then just doing a thorough analysis of all of the different options. Matt and Marcy and others, each scenario is different. Each client is a little bit different, and how they would like to wind up and wrap up may have different nits and tweaks, and maybe you sell the historical liabilities and sort of put the captive in dormancy for a little while and see if you need it again. And you always have to do a bit of a cost-benefit analysis there versus the cost of just shutting it down completely and forming a new captive versus putting a captive in dormancy against the possibility of maybe needing it again in the future based on insured/owners' business needs. So I think that's a critical aspect of analyzing the solutions, and then making sure the board really knows, the decision makers, the board, shareholder, et cetera, knows what those options are and makes an informed choice. So they're not coming back to you in a year saying, well, why did we liquidate when I could have kept it in dormancy and the phoenix rising from the ashes, reinvigorated the captive.
Good. Seamus, from the manager perspective, do these conversations come up with the owners where they're sort of like, what are my options? Is there a way out for me?
They do. As was just mentioned, there are a couple of options that always come to the forefront. Novations, commutations to get rid of the liabilities, but then you've still got a company that you need to get rid of. So that'll be a liquidation cost. I personally think the number one option is always to go with the merger. You need a willing buyer, and you need to come to an agreeable price. generally most captives, unless they're really towards the end of their life because they've just had really, really bad underwriting, there is some surplus in there, so they can find a willing buyer to buy that captive. They can merge it into their entities. They'll do their actuarial analysis on the liabilities, and then by merging the captive, you keep the whole history. You keep all the relationships that they may have had or may not have had with excess carriers, and it's alive. With the novations computations, you may get rid of the liabilities. You got to get, again, if there's excess carriers, get their permission. Then you have to liquidate the company. So generally, I think, and Greg, we've been in these conversations before, and Damien as well. You know, you'll list the options, but the best option out there is to merge with another entity. You either get a check as the owner, and you're done. It's all over now. You walk away, or you may have to pay them $500,000, whatever it may be, but then you walk away. There's no one going to be knocking your door in 5 or 10 years' time because there's policy that you own as a liability. So thankfully, we don't see them all that often, but the best ones that we've had have ended with a merger.
Good. Damien, from your perspective?
Yeah, well, I obviously have a bit of a vested interest in the entity continuing, as I think most of us here do. But notwithstanding that, you know, I don't think as auditors we have a great deal of involvement in what the decision is that gets made, other than helping a governance team understand the options. I've seen it done in a number of ways. You know, as Marcy said, I've seen businesses dispose of the operating segments of their insurance program and maybe just keeping an excess layer to keep their captive running. I've also seen them sell the captive through M&A process. So I guess I don't have an obvious perspective on direction. It's whatever's right for the company and their risk tolerance at the end of the day. But the only observation I had as I thought through this was there's potentially in some captives some tax arbitrage to be done. Potentially, it's a complex area, needs some consideration, but there is a little tax arbitrage that could release a little bit of value in the process, as there are in many other areas. I mean, Seamus spoke about there being some surplus there potentially, and so there are a number of considerations to make when you are looking at the many options. But I think I agree with Seamus, and the cleanest way to exit is through a sale.
Yeah, no, thank you. Yeah, from our perspective, and I think you mentioned it a little bit, Greg, the fronting arrangements and the collateral being tracked. Obviously, you know, when you're dealing with a fronting company, that is a sophisticated entity that knows what it's doing, and you know, those of us that have seen those contracts, they are almost completely loaded in the favor of the fronting company. And, you know, but there are ways to, you know, release that capital, and, you know, companies like ourselves have relationships with those fronting companies. So again, it's knowing that that there are options and knowing where, you know, to go to find those options. It is a, you know, relatively specialized space. There's a few players in that space, but I think, you know, as we've covered the whole journey of the captive from sort of birth, puberty, midlife crises, through to the end game, it's important to understand, you know, when you get into it, that yes, you should be in it for the long term. You should be in it for all of the right reasons, but you know, stuff happens, things change, and you know, you are able to change course. You know, you are able to, you know, there are options if those original plans, you know, no longer make sense through the life of the captive. So we're coming up. We've got about 10 minutes left. We've got some time for some questions, and I see 3 questions. So let's pick one of those. I don't know whether everybody can see those on the panel, but maybe Damien or Greg, what are the tax obligations to the corporate once the captive has been sold, especially if running across multiple borders? Thank you, Shanna, for putting those questions up.
There we go.
Greg or Damien, you want to take a stab at that one, the tax issues?
I'll start, and I'll lateral it to Damien as well. And from my perspective, there may be all kinds of different tax obligations or none at all, depending on what domiciles we're talking about. So, and I'm also, at our firm, we have tax specialists who would address this question. So not at the risk of punting on it, I'm happy to take something offline if anyone wanted to chat further, because I think that is a really complicated area that may depend on a number of different factors, from legal documentation, how the assets or company is sold, which domiciles we're talking about. And when you have multiple countries involved, it can get very complicated very quickly.
Sure.
Yeah, the only thing I could really add there is if you do exit from your capital arrangement through a stock sale, there are some very specific rules with what happens to net operating losses or deferred tax assets that may be sitting in that entity, that does restrict their use to the new owner. So there are, as Greg said, unfortunately, it's a very complex area that needs quite a lot of analysis, and there are some very specific rules to businesses that exit through a stock sale. So I think that's one way. You need to understand all the facts and all the moving parts to be able to give an accurate and complete answer.
Right.
And I'd also throw in real quick on that. It's not always just when you say tax, that could mean federal income tax, state tax. It can mean other types of filings that may be sort of legacy filings. Even though the captive is sold, you may have stub periods or other things that need to be done to close off your tax obligations for that year. So it's very complicated and would need to be analyzed, I think, on a case-by-case basis.
Sure, thank you. So question for you, Marcy, is there a size that a captive needs to be before a firm like RiverStone would consider buying or taking on that risk?
That's a good question, and we do get asked that a lot. Obviously, if there's more liabilities in it, you sort of get a little bit of economy of scale. So if they're too small, it makes it difficult for the sale of the captive to even make sense, or for the selling of the liabilities to even make sense. But what we always say is, come talk to us, we'll take a look at it, and if it doesn't make sense, maybe we can help you identify some of your issues and offer some suggestions. So it's not too small to come talk to us about, but in the end, it might not be large enough to make it worth the captive owner's while.
Thank you for that. So I think we covered this question, but Damien or Seamus, if you want to expand on it, is the manager or the auditor the best person to ask about exit solutions, as they have a vested interest in keeping the fee income? That's probably a cynical question, but
I kind of expected that question. So maybe Seamus, I'll go first and let you follow on. As I think about it, we want what's best for our clients. And my firm, Seamus's firm, sure, we're 3 different businesses, but at the end of the day, we want what's best for our clients. And so when the governance team reaches out to us and asks for advice, we give them the best advice that we think fits for their circumstances, without regard to our fee income. We've got a whole set of rules around independence and ethics. And whilst I understand the optical potential conflicts there, at the end of the day, we build our brand on providing the best advice for our clients and being a trusted advisor. And that's the lens that I would approach it through if a board of directors or management team approach me for advice on what to do next. James?
I totally agree. I mean, I hope all of our clients in the past have always agreed with your sentiments, Damien. And at the end of the day, I always look at a client that's been a long-term relationship. And, you know, if it's going to end in the next month or 6 months, be grateful for the time you've had with the client. And it's a bit like, you know, when you lose a loved one. This end of life determination, you know, if Damien gets asked a question or I do, then I say, well, we need the whole medical team. We need to get the local attorney. We need to get Greg and his team on the line, maybe the tax advisor, and get all of the doctors around the bed to talk to the captive owner and say, well, these are your options. I don't think we've ever said to a captive, oh, you're best running off this business for at least the next 10 years so you can pay me my money for 10 years. That's never a good solution because the money won't be there in 5 or 6 years' time. So it's best to be honest up front and give them the best advice at the earliest possible point in time.
Good, thank you. So I think the last question, at least I see, is, and maybe I'll take a stab at this one, with the massive increase in captive formations in the last few years, what captives do you think will be the biggest legacy opportunity in the future? I don't know at this point. I think as you've probably heard today, there's so many factors and influences that can impact the captive both internally and externally. I think, you know, obviously the more captives that are out there, the more opportunities there are that, you know, they go off the rails or they need an exit solution. But I think it's going to be hard to tell. Time will tell whether we see a massive increase in a certain line of business or a certain industry or a certain sector. But I don't know at this point. Okay, so I see one more question. Risks in the world today appear to be compounding. Should governments do more to incentivize more resilience in the use of captives to smooth volatility? Absolutely. Anything that promotes the captive industry will be very welcome to all panelists and the industry as a whole. But, you know, Greg, maybe you want to tackle that one in the last couple of seconds?
Yeah, sure. It seems like that, you know, I agree with your sentiment, but disclosing my conflict at the outset, certainly. What's interesting is we're seeing kind of a back and forth, both internationally and in the United States, with different captive domiciles, regulators trying to increase their flexibility to gain more business on onshore domiciles. And you know, at the same time, you're seeing increased regulation both globally and in the States with economic substance, which we touched on, and the regulation in Washington State that's you know, regulating things a little bit more intensely. So it's kind of this push and pull that seems to be occurring and making things easier and harder at the same time across the world.
Great, thank you. Well, at this point we're almost up at time, so I hope everybody enjoyed it. I want to thank Seamus, Greg, Damien, Marcy, and Captive Review for putting this on. I hope everybody enjoyed it. I enjoy webinars, but I do prefer the in-person conferences, so hopefully some point soon we can get to meet people in person. But for now, thank you and goodbye, and enjoy the soccer this afternoon if you're going to watch it. Take care.
Bye, everyone.
Take care, everyone.